If you're serious about your financial future, then you need these 5 different account types in your life. Each of these accounts is tailored to serve a specific function to help you achieve your overall financial goals. And when they're used in unison, they provide a well-rounded financial plan to help you live the life you've always wanted. So let's dive in at number 1, which is going to be an emergency fund. Now, I don't care what financial guru you listen to, the one thing that everyone agrees on is that you have to have an emergency fund in place. An emergency fund is a relatively small amount of money, maybe $1,000 to start, and then eventually growing into maybe 3 months worth of living expenses. And this money is kept easily accessible so that you can easily withdraw this money at a moment's notice. And the purpose of this fund is to have money at hand for when life throws us a curveball, for when some unexpected emergency pops up and we need to suddenly spend a bunch of money. It's inevitable that at some point we will all get fired, laid off, or need to replace our vehicle, or have some random medical emergency. And when these types of events occurs, it usually puts a pretty significant strain on our financial situation. And so you need to have a stockpile of readily available cash at hand to get you through these tough times without needing to rely on payday loans or going into credit card debt. Not only does this emergency fund protect us against the majority of life's misfortunes, but it also helps eliminate significant amounts of stress from our lives. I mean, being laid off from your job is already traumatizing enough without needing to worry about how you'll buy groceries until you find a new job. By eliminating the financial worries of being laid off, you can better focus on the task at hand to get back out there and start looking for a new and better job. Because you want this money to be easily accessible, you will typically want to put it in a high-yield savings account at a bank. Personally, I recommend online banks and preferably not at the same bank that you have your regular checking account with. The reason being is that online banks don't have the overhead costs that physical brick and mortar banks have, and since they don't have to pay all of these extra expenses, they can often pass those savings along to you, the customer, in the form of higher interest rates. And I recommend not having it in the same bank as your checking account because I don't want to log into my checking account and see all of this extra money for my emergency fund, because if I see it, I might be tempted to spend it. I want to be able to set this account up and essentially just forget about this money. Out of sight, out of mind. Personally, I have my emergency fund in the T-Mobile Money account. Now, I know this sounds strange, but T-Mobile has a fully functioning FDIC bank account, and it's actually pretty amazing. First off, no, you don't need to have cell service with T-Mobile. I don't, in order to get this account. But having an account with T-Mobile does help. The reason I recommend this account particularly is because it currently offers a 1% interest to all customers. And for reference, this is roughly twice the amount of interest that other high interest online savings account offers from giants such as Marcus by Goldman Sachs. And if you do happen to be a T-Mobile customer, you can get up to 4% interest on the first $3,000 invested, which is absolutely unheard of for a savings account. Number 2 on our list is once you have your emergency fund in place, it's time to start thinking about the future with a workplace retirement account. Workplace retirement accounts are commonly referred to as a 401k here in the United States, or in Canada are referred to as an RRSP account. But whatever your geographic location, their end goal is the same, to help you save for retirement. Depending on your employer, you may also be entitled to matching contributions, which means for every dollar that you put into this retirement account, your employer will also put $1 into the account up to a specified cap. This is essentially free money from your employer and will help you supercharge your savings rate for your future. If you get matching contributions, you should generally contribute the maximum amount for this match before you move on to other types of accounts in this video. Retirement accounts are important because at some point we all get old, busted up and broken, and are unable to keep working. And once we stop working, it's important for us to have enough money on hand already set aside for when we get to this point in our lives. Because when we stop working, we no longer get a paycheck, so we need to prepare for the future. Retirement accounts, such as a 401k, help us fully realize our golden years by lessening our tax burden. These accounts significantly reduce the amount of taxes that we will owe, and the less of our hard-earned money that we give to the government, the more money we will have during retirement for ourselves. Now, if you are self-employed, you aren't going to be eligible for a 401k, but don't worry. Instead, you have access to either a solo 401k or a SEP IRA and can contribute to those. Between the two, the SEP IRA and the solo 401k, I tend to prefer the solo 401k as it allows for both Roth contributions, while a SEP IRA is traditional only retirement account. And more on the difference between a Roth and a traditional a little later in this video. All right, so account type number 3 is going to be an HSA. An HSA is a health savings account, and it's pretty much the holy grail as far as tax benefits goes. But first off, I need to mention that not everyone is eligible for an HSA account. An HSA serves as a backup for your existing health insurance plan, and only those individuals who are under what is referred to as a high deductible health plan qualify for an HSA. So to find out if you qualify, simply call your insurance provider or your human resources department at work. And even if you do qualify, these accounts are so gangster that the IRS severely limits how much you can contribute each year. In 2021, that limit is going to be $3,600 if you're single or $7,200 for a family. Now, the benefit of these accounts is that it's the best of all possible worlds from a tax perspective, as long as the money is ultimately used to pay for health-related expenses. This means that when you earn the money, you won't pay any taxes on state or federal income taxes on that money. Then when you put that money into your HSA, you can put that money to work for you, and you can use it to buy things like stocks or bonds to have that money grow and compound, and any gains from this is also going to be tax-free. And as long as you ultimately spend it on health-related expenses, you won't pay any taxes when you sell those stocks or bonds and withdraw that money to pay for your medical bills. Now, once again, like I said, we're all going to get old and busted up someday, and when we do, our medical expenses could be pretty significant. This HSA supplements any existing insurance you might have, so this money could be spent on things like deductibles or copays, health services that your insurance provider doesn't already cover, and it can even be used for things like gas mileage to get you to and from your doctor's appointments. Basically anything that is even remotely health related. Number 4 on this list, an IRA. An IRA stands for an individual retirement account and is somewhat similar to a 401k that we talked about earlier. The difference is that a 401k is something that your job sets up and manages for you, and an IRA is something that you set up and manage. Now, you might be thinking that having someone else manage it for you is convenient, but it's really not. Since a 401k is set up by your employer, they are the ones that dictate all of the terms of that 401k. 401ks sometimes charge random fees, limit the types of investments you can invest in. Some 401ks allow for loans or hardship withdrawals, and some don't. For this reason, I always suggest using a 401k up until the point where you no longer get an employer match and then jump over to an IRA. Because an IRA gives you much more flexibility with your money. With an IRA, you can invest in pretty much anything you want. Stocks, bonds, etc. And since this is a retirement account that you will want to set up and essentially have it on autopilot, you don't want to be constantly managing this retirement account. For that reason, I don't suggest investing in flavor of the month stocks like GameStop or AMC. Instead, I suggest owning a simple index fund such as stock ticker VTI, one of Vanguard's index funds. The reason being is by owning this one stock, you actually own small fractions of over 3,000 different companies. This high level of diversification allows you to invest confidently over the decades. You can set it and forget it. Now, when it comes to IRAs, there's 2 general types, a Roth or a traditional IRA. With both of these types of accounts, they dramatically reduce the amount of overall taxes that you will end up owing. The biggest difference between these 2 accounts is when you have to pay that little amount of taxes that you will ultimately owe. With a traditional IRA, you get an immediate tax break during the year in which you earn and contribute that money to your IRA. That money will also grow tax-free, but at the end, when you do decide to retire and finally withdraw that money, then you will ultimately start paying taxes once you make that withdrawal. A Roth IRA is the exact opposite. You pay your taxes up front like normal when you earn the money, and then it grows completely tax-free, including when you ultimately sell that investment to spend that money during retirement. Now, both a traditional and a Roth IRA are good accounts, but I think that generally speaking, a Roth IRA is the better choice for a variety of reasons. A Roth IRA also has a few extra additional benefits of greater flexibility during the withdrawal phase, including if you ever need to make a withdrawal prior to the classical retirement age. With a Roth, you can withdraw your contributions at any time, tax and penalty free. You don't need any reason, you don't need to specify to the government why you're doing this. You can just automatically withdraw your contributions at any time. You only get penalized on any profits that you attempt to withdraw, as opposed to a traditional IRA that beats you up with all kinds of penalties for any withdrawals prior to retirement age. Now, obviously, I don't generally recommend withdrawing money from a retirement account before you actually retire, but at least with the Roth IRA, you have the option to do so if a big enough emergency were to present itself. Personally, I have my IRA with Vanguard, but any companies such as Fidelity, Charles Schwab, or others are virtually identical. Currently, the annual contribution limit to an IRA is $6,000 per year for most people. All right, number 5 on this list is a regular old brokerage account. Personally, I have my account with M1 Finances. They have by far and away the best tools to fully automate your investing, at least that I've seen. It's the only platform that I'm aware of where I can set up an automatic investment feature where it will automatically pull money out of my bank account each month and automatically purchase stocks or index funds according to my preset criteria. With all of the other brokerage accounts that I've seen, you can set it up to automatically withdraw the money from your account, but then usually you have to go in and manually hit the button to actually buy those stocks, which is nice that M1, you can just set it and forget it. So I can set this up once and leave it on autopilot for the next few decades. Now, a regular brokerage account doesn't provide any tax benefits, but the good news here is that there's no limit to how much money you can contribute each year, and you can obviously withdraw the money whenever you want. This can be a great place to let your money grow for things like a down payment on a house, money for future car upgrades, family vacations, etc. Now, if you are saving for a specific item in the near future, maybe the next couple of months or years, it may be worth investing in investments that are relatively stable so that you're not at the whims of the stock market and have it suddenly crash right before you think that you're actually ready to buy a home. But if you're in it for the long haul, then a simple index fund like VTI that we previously mentioned, or an index fund designed with dividends in mind, such as stock ticker VYM, may be a good option. Either way, just be sure to do your own research prior to making any investment decisions. If you enjoyed this video, consider subscribing, and as always, I'll see you all again next time. Thanks.